economic session. It's David here speaking, and sitting alongside me this week again is Jeff Saffo. Welcome, Jeff.
Thank you, Dave. Hello, everyone.
It's been a pretty volatile week on the markets, Jeff. We've had a series of announcements this week that has made the Aussie market in particular go up and down, and in particular the Aussie dollar. So let's get cracking and have a look at what we can expect in the forthcoming week, whilst we also review the week that we've just had. First, the disclaimer. The content of this presentation or any other Elite Traders Club presentation material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, or particular needs. So please consult your licensed advisor before taking any action based on the general advice presented in any of the following presentations. I think you all know the drill, so let's get on with it and let's review the week that was. Jeff, in Australia we had a series of announcements this last week. On Monday we had building approvals. We also had some data released from China. On Tuesday we had the important RBA announcement and what we were expecting from there. We talked about that last week. On Wednesday we had some retail sales. On Thursday some data came through in terms of employment change and the unemployment rate. And today at around about 11:30 we also had the RBA statement as well, on the back of the rate drop on Tuesday. So, Jeff, just like you to comment on some of those important announcements in the week just gone.
Yeah, no worries, Dave. Look, I guess building approvals I don't pay too much attention to. It's pretty lumpy month to month. Chinese PMI is a fairly important number, but I tend to focus more on what's called the flash release rather than this final one. So, again, not the most important one. Really, one of two things that drove the market this week was the first thing was the RBA cash rate, and the RBA cut rates by 0.25% down to 2%, which should have been good for the market.
Yep. And
should have been bearish for the Aussie dollar. Should have seen the Aussie go down. Instead, they went in the opposite direction, and part of that is because the RBA cut, and then they said in their statement, they dropped a part of the statement that said they were possibly looking to cut rates further again. So they basically said, look, we're cutting rates, and that's probably it for now.
Yep. So I noticed actually this morning, Jeff, that earlier in the week the Aussie dollar was up around the 80-cent level, and today, the last couple of days, it's just started to come off a little bit. So maybe having something to do with that statement?
Yeah, look, the RBA statement was what pushed the Aussie dollar up to 80 cents.
Yep.
So really, basically, RBA said or hinted that you're not going to get any more rate cuts for a while. Is the way it's being interpreted by the market. The other thing that was driving the market this week, it's not really up on the economic list there, but the banking sector.
Yep.
Partly because of the RBA, partly because of some things I mentioned last week. But we also had three of the big four banks come out with results this week. And they were pretty ordinary, to be honest. I've been saying for a while to my clients, certainly, that the banks don't have a lot of growth in them.
Yep.
And that really played out.
Sure.
So the banks weighed down. The banks make up almost half the market, and that's part of the reason why the Aussie market struggled. This morning, the RBA, you mentioned, came out with its quarterly monetary policy statement. Look, this shed a little bit of light beyond Tuesday's. Tuesday's is 1 page long.
Yep.
Today's 100 pages long with all of their thinking, and really it's consistent with what they've been saying, that they've seen some signs that the Aussie economy is, or household sector, strengthening a bit. Unemployment doesn't look as bad as they thought it was, and they're saying they will react in terms of interest rates. They'll react to however the economy carries on from here, but I'm not expecting any rate cuts anytime soon. Mm-hmm. Over in the US, probably the trade balance I mentioned last week because of the strong strong American dollar in recent months. That was likely to end up in a large deficit, which is what we've seen there. So whilst that was a lot worse than the market thought, that makes sense to me.
Yep.
Unemployment claims is a weekly thing, so I don't pay too much attention to that. But non-farms came in pretty much as expected, and non-farm payrolls had a disastrous month last month, so I think it'll bounce back this month.
Yep. Okay. Right, well, let's have a bit of a look at what happened on the markets during the course of the week. The Aussie market here, this time last week, I drew in whereabouts we were on the charts, and this is pretty much where we were here, where the cursor, where the cursor is, just below that. Just talking about the fact that the Aussie market had really just rotated between about 57.50 and the 6,000 mark, up and down. We had, since the beginning of the year, put on around about nearly 10%. Since then, we've retraced throughout the course of this week, and a lot of you out there will have seen that in your portfolios. And at the moment, we're sitting up around about 4.5% on the year to date. So just a little bit of a view, I suppose, a little bit of a look back in terms of the data that we had last week, or during the course of this week, and the impact that that's had on the markets as well. Jeff, I know I've talked to you a little bit about statistics on the markets in general, and typically we tend to have the sort of 5% corrections, if you want to call them that, or retracements on a fairly regular basis, don't we?
Yeah, look, I mean, obviously, your serious bear markets is when you get, a 20% move.
Yep.
You typically get a sort of a 10% pullback, probably once every 18 months.
Yep.
And these sort of 5% retracements you'll probably get a couple times a year.
Yeah, they're pretty regular.
And especially after you've just had a fairly big run, as you mentioned.
Yep.
Yeah, it's nothing surprising, to be honest.
Yeah, although when you're running a portfolio and you're doing this all yourself, sometimes those 5% sort of retracements can feel a little bit worse than what they actually are. So again, we'll only ever know in hindsight, but it's the sort of thing that we've got to get used to as medium to long term investors.
It's it can be pretty hard to time them.
Yep.
And make sure you get out before they happen. But occasionally there's warning signs. And an interesting thing for this one is that it happened pretty much at the end of April, early May,
Yep.
which is typically a weak time for the market. So I explained to my members the sell in May concept in a recent webinar. So something to keep in mind, that a bit of a seasonal factor here maybe as well.
Yeah, absolutely. And if we go across and have a look at the US at the moment. Currently up for the year, you'll see here just up 1.66%. So typically in the last few years, the US outperforming the Australian market, but more recently, as a lot of you would be aware, the US market sort of slowing down a little bit, stagnating, pausing for a little while, and eventually the Aussie market has been catching up a little bit and been outperforming of recent. So it'll be interesting to see what happens over the course of the next few weeks. So let's go ahead and see what data's coming out next week, Jeff. In Australia, we've got the NAB Business Confidence Survey on Monday. We've got the annual budget release, so we've seen Mr. Hockey on TV a fair bit of late. Then over in the US, we've got retail sales month on Wednesday. We've got unemployment claims, and importantly in China on Wednesday, we've got industrial production, and I'll get Jeff to talk about this in a moment, and also fixed asset investment on Wednesday as well. So I guess just before we jump into this, tonight, Jeff, in the US, we've got non-farm payrolls. We were having a bit of a look at the figures for that over the last 12 months or so. What's your take on non-farm payrolls?
Yeah, look, it's obviously one of the most important numbers to come out of America. Any jobs figures are important, obviously, in any economy, but particularly in America, where the consumers make up such a large portion of GDP growth and GDP. Yeah, look, as I mentioned, last month was the worst result we've had since early last year.
Yep.
And I think that will prove to be a bit of a blip. So I think the market's also expecting that number to improve tonight. I think you'll see something like probably about 230,000 jobs added for the month.
Yeah.
Up until recently, we've had some pretty strong numbers out of the US.
Yeah.
So that should get back to normal tonight. Then looking ahead to next week, business confidence is an interesting one. Look, it can be a bit skittish as well, but perhaps the rate cut will help them, and they could be nervous ahead of the budget. I mean, businesses, the one thing they don't like is uncertainty. I guess the budget itself, we've had a few little things leaked, obviously changes to the pension, some childcare funding, a couple of other minor items, but they're still not sure about a lot of the detail to come out.
So just thinking on that, the business confidence, given that the budget's coming out as well on the Monday, The results of that survey may not necessarily be an accurate reflection of how business is feeling right at this point, given that we're on the eve of the budget release.
That's right, and it can change significantly. So whatever that reading is on Monday, and then the budget comes out, depends what tax breaks or changes to regulations come out. The budget's very much also sector by sector, so it's not necessarily good for business, bad for business. Different industries react differently. So I'd say the next business confidence after the budget will be a real telling one. And last year, business confidence and consumer confidence took a belting, a real belting after last year's, I suppose you call it tough budget.
Yes.
You mentioned Joe Hockey's been on TV a lot. He actually hasn't been on TV much because they've been hiding him because he was I think he's associated with last year's budget. Instead, we've seen a lot of Scott Morrison for your little political comment there. But I mean, look, it's very interesting, and at this stage, like I said, we'll still wait to see, which sector comes out better and worse. But I think we'll see a much softer budget than last year. Again, without getting into politics too much, but I think the budget last year cost the government a lot of political capital, and they. I think they've learnt their lesson, and they're a bit scared of making some really tough, hard decisions this year.
Yeah.
So that'll be very different to last year. Over in the US, again, unemployment claims, not too fussed. It's sort of a weekly measure. I only really look at the overall trend. Retail sales will be an interesting one. We've generally had some improvement over there, so we'd want to see that continue. Consumer confidence is still fairly high in the grand scheme of things in the US. It's been improving a lot over the last few years, but a couple of months ago took a pretty big hit when the Fed kind of shifted things around. So that'll be interesting to see as well. You mentioned obviously looking at that chart there for China. Industrial production, so what this is showing the last sort of 7 or 8 years of industrial production growth, and you can see that we're the market's predicting 5.6% year-on-year growth, which is the lowest that we've seen since the GFC.
Yeah.
And even then, during the GFC, it only was lower than this for a couple of months. So it's really clear picture of the slowdown that we've seen in China over the last 5 years, and fixed asset investment tells an even more dire story, to be honest. Fixed asset investment is probably going to be at its lowest point in more than 10 years.
So what does fixed asset investment mean?
Yeah, it's looking at businesses buying long-term assets.
Right.
So they're spending on assets that are expected to last more than a few years, and it's typically also looking at opening up new factories and things like that, buying machinery. So it's related to the industrial production. Obviously, if you're investing more in these kind of assets, then down the track you'll start producing more. So it's a really telling point. I mean, it's month by month it doesn't mean that much, and it's not going to the market's not going to react all that wildly on Wednesday.
Yep.
But it's really just symptomatic
Yep.
of the slowdown in China.
Yeah. And you can see that the slowing trend in this chart as well.
Yeah.
Over the last few years, the trend is most definitely to the downside. During 2009 here, Jeff, it obviously came down very, very steeply, but then went back up very, very steeply as well. What was the main reason for that?
Yeah, look, China announced quite a bit of stimulus following the GFC, and you can see that, it's really interesting that the fixed asset investment was actually higher after the GFC than before. So, companies and the government was investing and proactively looking to grow even more than they were during the bull market. But of course, the stimulus can't continue forever.
Yep.
China's been very careful about introducing more stimulus in the last couple of years. There's been very little of it. It's been quite light. It's been targeted.
Yep.
They're a bit worried about overheating their economy. So you're really getting a clear pattern. China's slowing. The authorities aren't looking to give it a massive shot in the arm, and it's just a reality that we're faced with it. It's going to probably continue like this for some time.
Yeah. So we get quite often at the beginning of the week we get a lot of our leads from the US market, what's happened over the course of Friday in particular with non-farm payrolls, then leading into next week when we've got some business confidence surveys, the budget coming out next week, and then importantly on Wednesday some information from China there in terms of industrial production. So potentially getting our leads from the US over the course of the week, and then China perhaps in the middle of the week rocking the boat a little bit. So it'll be interesting to see what happens next week. That just about wraps it up for today. We've sent out the invitations already for the Monday weekly analysis session, so that'll be in your inbox, so check that out. And we will catch up with you at 9 a.m. on Monday morning. Until then, have a good week and stay safe.
Thank you, Dave. Thank you, everyone.